Now that we've discussed how to create personal financial statements, let's talk about how to use them. We'll use them to keep good records and organize our records and to track financial progress. So we can actually analyze these financial statements using ratio analysis on the balance sheet and on the income and expense statement. So on the balance sheet, the type of ratios that we will create or analyze first are the solvency ratio. So what this does is it takes net worth at a given point in time and relates it to total assets. So it indicates the potential that we have to withstand financial problems. Liquidity ratios are another way that we analyze our financial statements. And what they do is they measure our ability to pay our current debts with our existing liquid or current assets. So remember, current means when we're talking about debts or liabilities that they have to be paid within a year. So we're going to take our total liquid assets and divide it by our total current debts. Now moving over to the income and expense statement, we can create ratios to analyze that statement as well. So the first is the savings ratio. It shows the percentage of after-tax income that we're actually saving in a particular time frame. So it's our cash surplus, what we have after our income minus expenses, divided by our income after taxes. Then we have the debt service ratio. This indicates our ability to repay our loan obligations promptly with our before tax income. So we take our total monthly loan payments and divide it by our monthly gross income. So now let's move on to talk about budgets. A budget is a short-term financial planning report that helps us to achieve our short-term financial goals. And so by achieving our short-term goals, we're going to be better able to achieve our long-term goals. So the reason why we use budgets is to monitor and control our finances, to allocate income to reach our goals, to implement disciplined spending, to reduce our needless spending, because sometimes we don't even realize how we're spending our money, and as I mentioned a minute ago, to help us achieve our long-term goals. So the way the process works is first we have to estimate our income, then we estimate our expenses, and then finally we finalize the cash budget. So now what happens if we have a budget deficit? What we're going to have to do is shift our expenses from the months where we have a deficit to a surplus. So maybe we don't have a deficit for the whole year, but just certain months happen to have a lot of expenses coming in. So maybe we can shift those to other months. And then if that doesn't work, we might have to use our savings or investments or even borrow to cover our deficits. Now, what if we do end the whole year in a deficit? Then we might have to liquidate our savings instead of just doing a temporary shift. We might actually have to liquidate our savings or borrow for a longer period to cover the deficit. But what we really need to focus on doing is cutting our expenses and changing our spending habits and, if possible, increase our income. So now that we've got our budget working and we've handled our deficit, how do we use our budget? Well, first we use a budget control schedule, and that compares our actuals with our budget categories and shows our variances. And so we want to continually update our budget based on the actuals. So now, a very key concept in finance is the time value of money. And so what it tells us is that $1 today is worth more than $1 that we receive in the future, because that $1 today can be invested and earn interest. So let's talk about some time value of money, or TVM, calculations. First, there's a lump sum or single sum that could be invested without adding or subtracting anything from it. Or we could have an annuity, which is a series of equal payments made at regular intervals for a certain period of time. And we could be calculating a future value, which would be the value that our investment would grow to if it earned a specific interest rate over a certain period of time. And so the process of growing today's present value to a larger future value is called compounding. So if we calculate the future value of a single or lump sum, an example would be, what will $5,000 grow to if it's invested at 5% for 6 years? So our present value is $5,000 and our interest rate is 6%, or I'm sorry, 5%, and we're investing for 6 years. So we would take the present value and multiply it by a factor, and you can find that factor in a table at the back of the book, and that will give us the future value. So now let's switch to an annuity. What if you're investing $5,630.70 every year for 6 years at 5%? Now it's the same function, or kind of the same operation, but we need to find a different factor out of a different table. Now let's switch to present value. So present value is the amount that we need to invest today at a specific interest rate over a certain period of time if we want it to grow to some target future amount. So when we're calculating a present value, we're discounting, because remember, future value was compounding. So here's an example of present value. Let's say that we want to have $300,000 in our retirement account in 25 years when we're going to earn 5% interest. And so we want to know what single or lump sum amount would we have to invest today to grow to that $300,000 in 25 years at 5%. So first we have to find the present value factor out of the tables in the back of the book. And then to calculate the present value, we'll take that future value and multiply it by the factor. So the future value that we're targeting is $300,000. The factor from Appendix C is 0.295. So that's going to give us a present value of $88,500. In other words, we need to invest $88,500 today in order for it to grow to $300,000 in 25 years at a 5% interest rate. Now, if we had a financial calculator, it goes a lot faster because we could just plug all this in. So we can plug in $300,000 as the future value, 25 for N, 5 for the interest rate, and solve for the present value. Now let's do present value of an annuity. So we've got $300,000 in our retirement fund, and we want to take out equal withdrawals of over the next 30 years. So we're solving for what that withdrawal amount will be if our interest rate is still 5%. So from the tables, we need to find that present value annuity factor, and this time it's going to be in Appendix D. And so our withdrawal will be calculated as the future value divided by that present value annuity factor.